Good morning, everyone. It's Mick O'Brien. I'm the Managing Director of EQT Holdings Limited, and I'm here with Philip Gentry, our Chief Financial Officer and Chief Operating Officer. I want to welcome you all to the call. We're going to talk through the half-year results to December 2019. So first of all, I'm going to give an overview of the results and how the company is travelling. Philip's going to go through the detail of the financials. Then I'm going to come back and talk about our strategy update and the outlook for the company. And then we'll take questions at the end of the presentation. So it's been a very good half year. We flagged that we would invest over the period of the last 6 months and the last 12 months in the company, and we have done that. Our funds under management, administration and supervision, which is one of the key drivers of revenue of the organisation, are up 43.7% to 111.1 billion. That's not a typo. There's a lot of ones in that number. But it's the first time the company's exceeded $100 billion of funds under supervision. The revenue has been up 5.6% on the prior corresponding period to 48.9 million. Expenses are up 6.9%, reflecting the investment we have made in the company. Net profit after tax attributable to shareholders is up 2.3% to 11.5 million. The board have chosen to increase the dividend by 3 cents to 47 cents per share on the prior corresponding period. And the balance sheet remains in a really strong position. And this organisation is delivering with purpose for all of its stakeholders. We've been investing in people and technology through the course of the last 12 months, really, and that has been to capitalise on the continued change that we see in financial services. There's been considerable fallout from the Royal Commission that's been well talked about throughout the industry. There's been increased regulatory scrutiny, and that is causing organisations to consider their operating models. Our strength as a respected and capable trustee is really being increasingly recognised in the market. Our capability is in high demand by different organisations. And the restructures that are going on in the industry, where there's been divestments of very significant wealth, advice, insurance type businesses, has provided opportunities for us. The investments we've been making have been in people and technology, primarily in people over the course of the last 6 to 12 months, but increasingly on the technology side as we set ourselves up for increased scale. This has obviously involved higher costs in the short term, as you've seen in the expense line, but despite that, we're still performing well and delivering an increase in earnings, and we should be well positioned to produce long-term benefits for the organisation. Importantly, we are remaining true to our purpose, which is beneficiaries and clients first. That strategy, I think, has been delivering, very solidly for us. If I just now turn to the funds under management, administration and supervision, this is the key driver of revenue in the organisation, and really, I guess it's been an extraordinary growth over the course of the last 12 months, but particularly the last 6 months. You can see there that the funds have increased by $34 billion, and that has been both in trustee wealth services and in the corporate trustee services business. So we've had, very material growth in both areas. Some of the key appointments that have driven that growth that we've talked about previously is the appointment as the superannuation trustee to the AIA CMLA superannuation funds of $4.5 billion, and the appointment as the trustee or responsible entity to those same or a similar set of funds from the AIA CMLA group for $10.5 billion. We were also appointed as an authorised corporate director to a suite of funds from River and Mercantile in the UK, and in the Australian dollars, those funds are total $3.9 billion, and that's a really a headline client for us in that business, which I'll talk about a little later. And there's been a good pipeline of listed investment trusts. The latest one that we've had in the market was the Partners Group through this period, and we now have funds under supervision in the listed investment trust space of more than $2 billion that has been built in the course of the last 12 months. If I just look at all the key financial metrics, and I think the first thing to note on this slide that all those metrics, without exception, have shown consistent increase period on period. You can see there the revenue up 5.6% to 48.9 million. Net profit after tax is up 2.7% to 11.5 million. The earnings per share up 1.2% to 55.78 cents. And as I mentioned before, the board chose to increase the dividend and increase it by 6.8% to 47 cents for the interim period. This slide's important because these four sets of stakeholders drive all of our corporate behaviour. T1 is the prime purpose of this organisation is to deliver to our clients and our beneficiaries, and that will be a focus for this organisation that is ongoing. A healthy company delivers to all of its stakeholders in a balanced ways, to our clients, to our employees, to our shareholders and to the community at large. And I feel that Equity Trustees has certainly done that over the last 6 months. We use this framework primarily for our employees so that they've got a very clear understanding that they need to be delivering for all of our stakeholders, and I think it's worked well for us. I'll just touch on each of those key measures. So you can see on the left-hand side our client measures, a Net Promoter Score and a Net Loyalty Score. This is, as I said, a long-term journey for us. We're about to be surveying clients again over the next 2 months. We're each year extending that survey to a broader part of the client base, and in this particular year, we'll extend it to members of the superannuation funds, and we'll also extend it to community members in the Indigenous communities that we're looking after. On the right-hand side, you can see our two key measures of how our employees are tracking their engagement and our ability to enable them to do their job. This has been, if you like, our original focus when we started this journey 3 years ago. I think we've achieved, really excellent results. We're about, again, to survey our staff, but this is our staff are our most important asset, and I'm really pleased with the progress we're making there. Now, on the left-hand side is the shareholder measures. Our focus on increasing shareholder value is primarily on EPS growth. Importantly, you can see the consistent increase in earnings per share on the left-hand side there, and that is without any material increase in gearing, and we're not going to be gearing this company up to any great extent. And on the right-hand side, our ability to convert those earnings into cash and dividends while still allowing the company to grow and invest for the future. On the right-hand side, you can see one measure of our impact on the community, and I'll come to more as we go through the presentation, but we finished a record year last year with $124 million of distributions and grants being made into the charitable and the for-purpose sector of the Australian community. Whilst distributing money is really important, the most important thing is the impact that we can have on the community. We put a lot of resources into ensuring that those grants are made to the most impactful places that we can make them. So that's a summary of the results. I'm going to hand over to Philip to take you through the detail of the financials and come back and talk about strategy and outlook later.
Thank you, Mick. Let's start, first of all, with a bit more of analysis and detail around the income statement. Here you can see a summary, and if we just work through from top to bottom, you can see the revenue growth is pretty solid there at 5.6% increase. Expenses up 6.9%, reflecting the investment in particularly people and technology to support the pipeline of growth that we have in front of us. You can see the net profit before tax margin is slightly down to 33.1%, reflecting this increased investment. And then bottom line, slightly ahead of the AGM guidance we gave of being in line with the prior corresponding period, with moderate increases in NPAT, earnings per share, and dividends. Now let's just look at the revenue growth in a bit more detail. You can see here on this slide the split between the equity market impact and the organic growth, and I'll show you how that breaks down into TWS and CTS shortly. But in summary, TWS has had a particularly strong half, one of its better halves in recent years, and CTS, while solid, has also been particularly supported by the MSCI. Now let's just have a look at the cash flow breakdown. Here you can see we continue to have a strong operating cash flow, and just looking at this chart from left to right, you see the net cash flow from operations pre-tax of about 9.7 million. Some proceeds from borrowings there of about 7 million. That was associated with CMLA, this particular transaction where they provided funding to us to support the operational risk financial reserve capital associated with the superannuation activities. I'll talk a little bit more about that when we get to the balance sheet. But essentially, cash flow generation remains quite strong. We have negligible bad debts and a modest increase in borrowings. Let me now turn to TWS and talk a little bit more about its particular performance during the half. On this slide, you can see they've had pretty good performance. On the left-hand side, the split between the equity market and the organic growth. And on the right-hand side, a material increase in the funds under management, administration and supervision, particularly driven by superannuation, but also growth in most of the other areas as well. Let's have a little bit more of a look at the private clients component of TWS. On the left-hand side here, you can see our more traditional core trustee services. You can see reasonable momentum in all of those, particularly in perpetual charitable trusts. We've had 5 new trusts recently, and a reasonably steady growth in FUMAS across the board. On the right-hand side are more emerging markets, our more recent businesses. Much faster growth, but of course from a lower base, and we're quite encouraged by the momentum we're seeing across those activities. Then turning to superannuation. Here on the left-hand side, you can see the funds under supervision and the material increase you can see there, in particular driven by the Zurich acquisition and the appointment to CMLA AIA over the last 6 to 12 months. On the right-hand side, you can see the number of superannuation trustee office members, which has increased over 50% through these appointments. You can see below that there was a much larger number originally, but of course quite a deal of those members have been transferred to the ATO, which was always contemplated at the time. Now turning to CTS and taking a bit more of a look at their performance. On the left-hand side here, you can see a waterfall which just breaks down their revenue. There was, in the previous corresponding period, quite some significant one-off closure fees, which was unusual. If we back those out, you can see the split between the equity market impact and organic growth. The organic growth a bit more positive, positive but not quite so marked as in previous years. You'll be aware there's quite a lot of change in the funds management industry, and that's impacting CTS to some extent as well, although the business continues to grow reasonably well. You can see the headline half-on-half revenue growth of about 4.2%. Quite strong support from the MSCI, quite a number of new clients there, and quite substantial increase in funds under supervision. And then in the UK, you can also see on the bottom right of the slide some very significant new appointments of both local fund managers and US fund managers there. And then turning to the corporate trust and securitisation division, which we're investing in, but still relatively small. You can see on the left-hand side here the revenue growth half on half on a PCP basis. On the right-hand side, the funds under supervision growing. We're quite pleased with how this business is growing. We've had our first securitisation deal complete, where EQT acted as trust manager as well as the issuer and security trustee. There's a strong pipeline of new business, and we're encouraged by the outlook for this particular operation. Now turning to the balance sheet. Here you can see the last 3 half endpoints. Continues to be quite strong. You can see the borrowings increase there, which is largely around the CMLA and the operational risk financial reserve. The cost effectively is met by CMLA, or we're reimbursed to the same extent. So, effectively this capital is outside the fund and it's provided as part of our trustee activities to support the CMLA super fund. We continue to have the contingent liability we've referred to for some halves now in relation to this dispute with the ATO. That's up to around 3 million, but we remain confident in our position and hopefully we'll resolve that in the 6 months ahead. A little bit more information around capital. Continues to be very strong position, low gearing, healthy liquidity and a net cash positive position. We have now released about 3 million of capital following the transfer of former OneView RE clients to our Equity Trustees Limited licensed entity. There are some additional capital release opportunities which we're continuing to work on over the next 12 to 18 months. From a dividend standpoint, the payout ratio was about 84%, well within our 70 to 90% NPAT payout range. We continue to have plenty of flexibility for further investment or inorganic activity should such opportunities arise. So in summary, the financial performance has been quite positive despite the high investment, good revenue growth, increase in NPAT and dividend. All the businesses are performing well and we see a growing pipeline of opportunities. Significant investment in the resources underpinning our ability to take advantage of these opportunities. We have the balance sheet strength and capital capacity to support our growth plans. I'll pass back to Mick now to update you on the strategy and outlook.
Thanks very much, Philip. Let me just talk about our strategy and the outlook for the company. Our vision hasn't changed to be Australia's leading trustee company. It's simple, it's clear. I think we're well on our way to that. Everything the organisation does, it puts its capital, its intellectual and financial capital into this pursuit of being Australia's leading trustee company. It is a privilege to be entrusted to be a trustee in almost all the appointments that we take on. We never lose sight of that purpose of the organisation to protect others' interests. Let me move on to how we see the landscape at the moment in the Australian financial services market and how we're positioned. The last couple of years has really highlighted the need for specialist expertise in trusteeship and governance, and particularly expertise that is unconflicted and not, if you like, engaged in other parts of the value chain within financial services. So our expertise goes back 130 years, starting, as a trustee and providing executive services to families and businesses. We've developed that into the corporate market, into the funds management market, and into the pension market. And we really do have deep in-house skill in all of those areas of trusteeship. And primarily that comes from the people in the organisation, and it is very difficult for other organisations to replicate that level of experience. Our independence is important. As I said before, we're solely focused on one issue, which has been trustee, looking after the interests of beneficiaries, investors and unit holders in the various funds and trusts that we manage. The independence is something the financial services industry has been, increasingly looking for in the last year or two. And governance really is our business. And so governance really is about risk management and compliance. It's about taking fiduciary decisions appropriately and all parties being able to trust in, if you like, the trustee governance, which sits at the apex of all of the arrangements that we have in place. Now, the opportunities have been considerable over the course of the last 6 to 12 months, and particularly in the superannuation space, as there been a flight to independence and experience in trusteeship. There is regulatory change that is driving activity. There continues to be regulatory change in all areas of the business, and both of the main regulators, APRA and ASIC, have more intense oversight of parties that are involved in financial services, and that is really leading to opportunities for us. Also, the divestments that have been occurring throughout the market as organisations exit the wealth space and the insurance space and the advice space has also provided opportunities for us. And coming to our private client business, really the demographic trends are what underpins the growth of that business. And we are starting to see a bulge in intergenerational wealth transition coming through, and I think our business is well positioned to capitalise on that. And finally, we are looking to leverage our impressive list of global funds managers that we have in corporate trustee services to build our business in the UK and in Ireland. If I just move on to how we're positioned, I've talked a lot about people. Over the course of the last 6 to 12 months, we've put a lot of investment into our people, both in our training, but also in recruiting high quality, experienced senior people into all parts of the business. And the areas where our focus has been asset management. It's been our risk and compliance function. It's been in our superannuation trustee office where we've experienced significant growth, and also in trustee wealth services, the private client side of that business, particularly in client-facing roles. I should also say we've strengthened the holding company board with the recent appointment of Catherine Robson, and we've also put 2 new appointments into our superannuation subsidiary board, and both contributing very well to the governance of that business. I think increasingly Equity Trustees is being seen as an employer of choice. We don't compromise on the way we go about our recruiting because this is a people business. You will see in the future more investment in technology. We've been making that across the whole business. I think I'd categorise it as being in smaller, very targeted types of investments rather than wholesale technology program changes. But very important that we continue to do that to cope with the scale of the business as it increases. And finally, Philip's talked a lot about the financial capacity of the organisation. We have a very strong balance sheet and are able to fund investments and take the opportunities that are in front of us. That has, over, I guess, the last 6 months involved a higher level of investment than what we would normally have, but that is setting us very well up for the future. And we expect on the clients that we've taken on in the last window of 6 months and ones that are in the pipeline that will be well positioned to continue to grow. If I just touch on each area of the business briefly, and I'll start on Trustee Wealth Services and the private client area and just walk around this slide quickly. If I look at estate planning, our focus is on selective partnerships. So we're partnering with the right types of distributors. We don't have a mass market approach to estate planning. We have a highly sophisticated team that are capable of doing all types of complex estate planning, and that's where we focus our distribution activities. In our advice area, our satisfaction results are outstanding from our client base, and we're looking to capitalise on that to cross-sell other opportunities into our estate management area and our testamentary trust beneficiaries to continue to build that advice business. In philanthropy, I've talked about the giving that we've done in the course of last year. I do want to mention we published our annual giving review last week, and that really highlights the capability of the team to make the most of every dollar that we're putting out into the community. What we're trying to do here is, accelerate people to give while they're still alive and not wait till they're passed. Our business has been primarily built on testamentary philanthropy, but increasingly Australians are looking to start their philanthropy activities, when they have sufficient wealth. And we're setting the business up to do that and cross-selling into our estate planning and advice relationships. In estate management, we rolled out a new platform through the course of the last 6 months that is all focused on improving the beneficiary experience and enabling us to cross-sell our other services. On funds management, we've continued investing in the team and building it out after the appointment of Darren Thompson and Chris Haynes 12 months ago. And I'm really pleased to say that the alpha generation over the course of the last 12 months has been really positive for our clients. And finally, in trust management, we're focusing in on our specialist areas where we're continuing to grow, providing services in compensatory trusts and also to Indigenous communities. And we're continuing to invest in more people in those areas. If I turn now to the superannuation area of Trustee Wealth Services, and this is an area that has been growing very strongly. I've said before that when people are looking for specialist trustee services and independence, that is mainly coming out of the superannuation space, where most superannuation players, this trusteeship is not their core. They're in superannuation for another reason. So our service provides them the ability to, address the vertical integration and potential conflicts of interest, and we're seeing really strong appetite for our services, and there's regulator pressure that is shifting, the focus of business our way. We've got a really good pipeline of opportunities in front of us at the moment. These opportunities generally take a very long lead time to be put in place, but of course, once in place, we expect to have long tenure of appointment in these arrangements. We're investing ahead of the curve in all areas of the business, but particularly so in superannuation. So when we're taking on large-scale appointments, we need to have those people on ahead of time. I think this area of the business has increased from something like 17 people 12 months ago to 23 now. But importantly, we've put in very senior people in client-facing roles on the legal side and on the insurance side, so this business is really well set for the future. If I turn now to corporate trustee services, this has been, a consistently growing business for us over the last decade and even before that, and we've built up a real leadership position in providing responsible entity services to fund managers in Australia. The client base is a great mix between domestic fund managers and global fund managers, and we continue to see new entrants into the market. And more often than not, equity trustees will have the potential, the opportunity to win those clients as they enter the Australian market. We are increasingly focusing also on the superannuation part of the market in this area because of the assets internalising to superannuation funds and those funds requiring collective investment vehicle structures, basically, and requiring trusteeship or responsible entityship in those types of arrangements. Should also say that the greater regulator scrutiny has caused some fund managers who have their responsible entityship internal to consider outsourcing those arrangements. So we're seeing increasingly larger scale opportunities that we wouldn't have seen some years back. Again, they take longer to put into place, but should provide greater tenure once if they are put in place. Finally, Philip commented on how the business is developing in our structured finance area, where we're participating in securitisations and loan and debt arrangements and real estate and custody arrangements. So that's an increased focus for the business over the last couple of years, and we'll continue putting people into that area. And in the listed investment trust space, I know there's been a lot of writing about this in the press in recent time, and particularly in the last month since the government announced their review into this area. But we've built a great client base here. We have assets in excess of $2 billion now from a standing start of 12 months ago. And importantly, I want to make a couple of points about this. These are really high quality funds managers that we're bringing into the market with investment strategies that are in high demand. If I now just turn to the UK and Ireland business, and this is this slide shows you how this business is progressing, but I think it's the best way to show how we're moving forward into the future with the business. The first two graphs are really early indicators of success of funds flow. We can't get funds flow unless we have clients and we have funds established. So our number of clients has increased from 6 to 9 from the prior corresponding period. The number of funds has more than doubled from 8 to 18, and we have a good pipeline about to come on at the moment. And the funds flow, and this is expressed in pounds, we've now gone at just above £2.5 billion in that area. Importantly, we're picking up quality UK and US managers. We established our office in Ireland, within the last 12 months, and a direct licence from the Central Bank of Ireland. We've also established a ICAV Irish platform, which allows us to bring on new managers as sub-plans into a platform that already exists. That's a lower cost entry for fund managers, and it opens up our business to a broader market. So we're really happy with the progress as that business continues to build. Now, finally, be remiss of me not to talk about the disastrous bushfires that the Australian community has experienced over the last couple of months. Equity Trustees, given our purpose is to look after others, has been instrumental in establishing two trusts with really the impetus from our chairman, the Honourable Geoffrey Kennett, to look after the volunteers' families who have passed away, the volunteers who have passed away in the line of duty over the last couple of months. That trust has been established. The Community Rebuilding Trust has also been established to try and rebuild the fabric of communities where government and council will leave some gaps, no doubt. We're providing our services to establish these trusts on a pro bono basis, and the Volunteer Support Trust on a pro bono basis forever. With the Business Council of Australia and Jeff's efforts, we've put together advisory panels for both these trusts to help us in making the decisions as to where funds are directed to, and it's a really impressive list of eminent Australians who are putting forward their time to help us in this. So we're delighted that we can do some part in helping the Australian community recover from this disaster. I'll just move on to Indigenous communities. This has been an increasing focus for us over the last couple of years. I'm pleased to say we're just putting in place our second reconciliation action plan, which really provides us with the skills and capability to make sure we're servicing these communities in the best way possible, and also improve the way we're putting philanthropic funds into the Indigenous community. We've established an advisory committee with great people who've got experience in these communities from across the country. We've got, I think, most of the states covered: Western Australia, Victoria, and Queensland and New South Wales with the people we've put together on this community. We've won 2 new accounts in the Pilbara, which is really important. That is where the bulk of the funds are, so I'm great to see that traction. And we're, I guess, extending the way we invest some of these trusts to increasingly move into impact investing, which I think is a greater trend in philanthropic trusts, but important in these areas that we can not only do great granting to the community, but also make those investments work for the communities. So in summary, we have a clear growth agenda. The industry is transforming and is providing equity trustees with more opportunities. We've invested over the last 6 and 12 months in our people and technology, and we will continue to do that because of the pipeline that we see coming forward. We're pursuing both organic and inorganic opportunities. I think our strengths as a respected and capable trustee are being increasingly recognised across the whole market, and they are in demand. The benefits of the investments are expected to flow. So you can see the significant growth in funds that we've got. It hasn't produced, a full period of revenue, obviously, in the last 6 months, but the clients are on board. Market volatility will obviously always continue to influence the outcomes of this company. And we have an encouraging outlook for the remainder of FY20 and beyond. So thank you for that. I'd like to now open it up to questions, and happy to take any questions that anyone has. Right, we have one question here, and it relates to the government's review of the stamping fees applying in the listed investment company and listed investment trust market, and whether that'll have an impact on future pipeline of opportunities. Firstly, I'll say a couple of things about that. In all of the raisings that we've done in the listed investment trust market, the funds managers have met the distribution cost of those raisings. So the clients have started their journey with an NTA equal to their issue price. I mentioned before that we've brought great quality managers with a really diverse range of asset classes in the set of products that we've brought to market. So, but investors are seeking higher income and going up the risk curve. There's no question about that. The government will determine what they're going to do with the stamping fees. If there's change, yes, it may slow some of the new offers that were planned to go to market. But I think the managers that we're talking to are still see that there is high demand, particularly in the self-managed super fund sector, for more diversified investment strategies. And I think they'll continue to pursue those opportunities. We've got one more question here, which relates to the increase in the funds under management, administration and supervision have increased significantly, but it appears that the revenue associated with that is at lower levels than what we've previously written our business. That's a fair observation, but there's a couple of points that I would make to that. One is that and particularly one of those appointments is in an area that really is a wholesale type of area where we are the trustee, but the clients, the beneficiaries and the investment manager are one and the same. So that's a simpler arrangement for a trustee to take in place. So it obviously doesn't come with the same risk, and it doesn't generate the same sort of level of fee. The other issue I'll just sort of bring out is that we wanted to build the capability and build the client base in our UK and Irish business. And on one of those appointments, we've, if you like, started the fee at a level that it will revert ultimately to a more standard fee. In any event, so there's no change in our pricing strategies overall, but this particular window of funds that have come on in the last 6 months, have some unique characteristics to them. We've got another question here in relation to Sargon. So Sargon's a player that provides superannuation trustee services and custody and RE services into the market, and it's recently experienced some issues and has some receivers and administrators appointed within the group. Is Equity Trustees interested in taking on some of that business? Look, the answer to that is we're watching those developments closely and with interest, and can't provide any other information in relation to that. But we'll continue to monitor that situation and continue providing services to the clients who are interested in our services. Well, I don't think there's any other questions coming through. So we might leave it there, and Philip and I thank everyone for their attendance this morning, and look forward to seeing shareholders, some of the larger shareholders out over the next course of the week. And thank you very much for your attendance this morning.